The purpose of financial reporting is to provide relevant, accurate information that gets shared in a timely manner with people that want to use that information. Well, what type of information would they want to use? Certain things are required to be reported when you hand out that information to users of your information, and they're very familiar to concepts you've already learned in your previous accounting classes. You need to have some point in time elements. These in a less wordy definition that's presented in front of you are your balance sheet accounts. All of the assets or resources that your company has to work with, all of the debts or liabilities that you owe to somebody else, and overall, what is the value or the equity of your company. But you also need to report some period in time elements, and these would come on your other financial statements, namely your income statement. What amount of revenues did you experience over the last arbitrary period of time? Could be the last quarter or the last year in total. What amount of expenses did you pay? What was your profitability? How did the value of your business change over the preceding business period or the business year? All of those need to be reported to people to help them make a accurate and informed prediction about your company. So, our point in time elements, assets, things that we're going to use to do the thing that we do to provide economic benefit for our company. They're going to be all of your inventory, your equipment, your other long-term assets like your trucks and your buildings, etc. Any receivables that you have on the books, all of those values have to be reported at the end of the period. Liabilities, what you owe someone. At any given time, you'll have your short-term liabilities like your accounts payable, interest payable, salaries payable, Excel, etc. But you could have some very long-term debt as well, any mortgages or long-term notes or bonds that your company has. And then equity is the net value of the company, is theoretically what you would have remaining if you liquidated all of your assets, converted them into cash, and then used that cash to pay off your liabilities. What would be left over? Well, that's the value of the business or your equity needs to be reported at the end of every accounting period. Other things that can happen over a period of time that need to be reported are investment by owners. For a small business, it could be assets that are donated to the company. But for the greater picture of things, it is funds raised by selling ownership of the company, by issuing stock. That's new owners investing in your business. And you need to tell people what amount of investment you have received from owners, not only during the last period of time, but overall. And then things that go into the business get reported, things that come out of the business also need to be reported. You need to tell people what amount of your profitability was actually distributed to owners. And the biggest form of this is dividends. So when you take money out of the business to pay dividends to your shareholders, you are decreasing the value of the business. And people deserve to know how much you paid out during the period in case they're interested in investing in your company, but also how much you decreased the overall amount of assets that you had to work with in order to make your owners happy. You need to report your profitability for the period, and the term here is comprehensive income. What is the difference between net income and comprehensive income? The way that I tell my students is comprehensive income is a picture of what net income could have been. It will include your net income, the actual amount of profitability you recognize, but there's other items in there that you could have increased your profits by. Two of the big ones that you're going to have are any unrealized gains or losses that you have on any asset. So say you invested in a company, but you've not yet sold it. If it's gone up greatly in value, you could have theoretically sold that and recognized a huge gain on investment sale. While that wasn't part of your actually realized net income, that unrealized gain could be part of your comprehensive income. Another big thing that would go in here is what they call translation adjustments. It's international business nowadays. You will sell to other entities that might be paying you in euros or the Brazilian real or whatever currency you want to go with. Well, exchange rates change over time. So as you're going through, the amount of money that you expect to receive on a receivable could increase or decrease in value as the exchange rate changes. You could sell that to somebody else during the time and turn a gain on that translation adjustment, as they call it. But if you haven't, it doesn't go into your actual realized net income. It's another measure of comprehensive income. So all in all, comprehensive income is the change that you have in your equity during the period from anything besides investment by owners, funds received for issuing stock, or distribution to owners, the amount of dividends or withdrawals that you've paid out to owners during the period. Speaking of revenues and gains and expenses and losses, what's the difference between a revenue and a gain, and what is the difference between an expense and a loss? And the big thing that you're looking for here, in my opinion, is it part of your normal operations? If something is a part of what you normally do day to day of your core business model, it's a revenue. If you sell something, you're going to have sales revenue. If you provide a service, you're going to have service revenue. If you have buildings that you rent out each and every period, you're going to have rent revenue. So anything that's repeatable and a part of what normally happens within your business gets recorded as a revenue. A gain is an increase to your profitability, which ultimately will increase your equity. That's the result of something outside the normal realm of your operations. If you invest in another company and you sell those shares of stock that you purchased for a huge profit, if you're not an investing firm, if you're a manufacturer, that's not part of your normal core business. It wouldn't be recognized as a revenue. It would be recognized as a gain. And you need to differentiate between those two when you report so people know what the profitability you're getting is from your core operations, because you can expect those to happen from period to period to period, where a gain probably won't happen every single period that you have. It lets them predict what your profitability is going to be in the future. And expenses and losses, the same theory. Expenses stem from your core operations, paying your employees their salary, paying rent, advertising, things that you do every single period get reported as expenses. Whereas losses are things that happen outside of the normal course of your operation and aren't part of your core business, but they aren't things like distribution to owners. They're things like a loss on investment sale, or God forbid you get 7 feet of snow in upstate New York and your warehouse collapse. That's not something that's normal of your operations. You would have a loss on asset impairment for the damage to that building. So you need to separate all of your inflows, if you will, of profitability, your revenues and gains, and all of your outflows, your expenses and losses, into the two different categories to let people know what is normal and what is going to be repeating and what is not. Other things that need to be recognized on your books are revenues and expenses in the period that they happened, or the acquisition of assets in the period that they happened. And that's incredibly important because if you're a publicly traded company, which if you're a CPA, you're probably going to be looking over a lot of publicly traded companies, you have to use accrual accounting. You don't record things when actual payment happens, you record things when they happen. If you acquire an asset during a period, you need to put it on the books during the period that it happens. If you provide a service, even though you've not yet got paid during an accounting period, that revenue has to be recognized during the period that it happens. So, for the purpose of this class, throughout the thing, we are always going to assume that we need two accrual accounts because big companies, companies that sell stock, or companies that make more than $25 million in revenue have to use accrual accounting by rule. And small companies, while they don't have to, they can elect to do if they want to. Anybody in here that's going to be accounting for people that run a small business when they file their Schedule C for their business income, there's a thing on there that says, what recognition basis are you using, cash or accrual? And you're more than welcome to check the accrual box on there. So accrual accounting is, in my opinion, the better way to account. It gives you a more accurate prediction of the financial position of the company that you're accounting for, and it helps people make better decisions. And it's less easy to manipulate as well. So, for recognition, when something happens, it's got to go on the books, and it's got to go on the books during that same period. Any big acquisition that you have better be reflected in a line item somewhere on your financial statements. If you bought equipment, your equipment balance better change during the period that you acquired it. As soon as you know that you have something that needs to be reported, the acquisition of an asset, the earning of revenue, etc., and you have a way to measure what it's going to be valued at, and you know the proper procedure to represent it according to GAAP, it has to go on your books according to that procedure. For revenues, that means you're going to recognize stuff when it's realized or realizable, not when you actually get paid for it. If you do a job for somebody, if your customer that you're accounting for did a job for somebody and they billed them, that revenue gets recognized during that period, not when the customer actually gets paid if you're using the accrual basis. Expenses Same thing. If you have a cost, if you get a utility bill for your utilities during July, even though you're not going to pay it till August, it should go on the books as soon as you know you owe for those utilities. Because you use them to help you turn a profit in July, that expense should be recognized against July's profitability. So as soon as you definitively know that you have a cost that was incurred during the period that has to go on your books, and you have a way to measure it, which is easy enough with a bill, it's how much the bill is for, and you know the proper accounting treatment for it according to GAAP, you should be recognizing that expense during the period that it actually incurred. Some other expenses that you're going to recognize, or this is just a rehash of things I'm sure you've already learned, uh, are tied to a specific event happening. And the big one is your COGS, your cost of goods sold. If you are a company that manufactures goods or you're a retailer that buys goods to sell to people, you don't get to record the expense at the time that you are acquiring or finishing the goods. You don't get to recognize the expense until you have the revenues to match it. Namely, to say that you can't recognize any inventory related expenses until they're actually been sold. So you recognize the expense at the same time that you recognize the revenues. There are other items where even though you haven't come to a particular date, we'll say a pay period for your employees in here, even though that date hasn't rolled around, you know that you owe it, and this is why you have to make adjustments. So like a salaries and wages expense, you might have periods and you will have periods where people worked days during one accounting period and they won't get paid till the next accounting period. Well, you need to put that expense on the books in the period that it incurred. And another one, which you're going to have whole chapters dedicated to in this class, is the purchase of long-term plant assets. You're not under accrual accounting allowed to expense the entire purchase at the time that you buy it. You have to systematically record that expense spread out over the period of time that you actually intend to use that asset, and that's called depreciation. So certain line items, well, there's the general theory of the conceptual framework of when expenses should be recorded. The expense should match the amount of time or the period that it helps you generate revenue. And like I said, accrual accounting is the basis by which the vast majority of large companies account. GAAP requires you to do so. So recognizing your revenues and your expenses and your purchases and your liabilities, your obligations at the proper time according to GAAP will help give people an accurate portrayal of your information. And the rules get complex. I have given you a link in the announcements to the FASB codification. That is a comprehensive guide to all the different GAAP rules that you have to abide by when you are accrual accounting. It is not the easiest thing in the world. You're going to find yourselves having times to go through and say, okay, what does GAAP say is the proper treatment for this to, make it accurate and representative of the company's financial position. You're going to have to go and look it up. But in the end, that is what you end up with, a more accurate portrayal of a company's financial position because you are adhering to the conceptual framework of what accountants should be doing. That being said, for any of my future CPAs in there, you might have small businesses that do not have to accrual account because they don't meet any of the requirements that require you to accrual account. And they'll be able to report on cash basis. Well, in theory, the same thing is always going to be true. You're trying to make the most accurate portrayal of that company's financial position that you can, but the recognition timing is vastly different. Cash basis is so much easier to account for because you don't put things on the books until cash actually changes hands. So while I'm going to be focusing on accrual accounting throughout this entire semester, just know that all of these concepts apply to cash basis accounting. It's not that you treat them differently in terms of how you record or value something. It's when you put it on the books. Cash basis accounting, you don't recognize an event or a transaction until cash actually changes hands. So it gives a good measurement of the amount of cash that a company has at the end of the period, but it's not the greatest measure of their economic activity. And by that, I mean it's plausible if you're a company that is at the very end of the tax year that you've done a ton of work, you can ask your customers, please don't pay me to January. That way I don't have to recognize all of those revenues and pay taxes on them, which is why Big companies aren't allowed to use cash basis. It's just way too easy to smooth out your earnings. Whereas small companies can get away with it because, yeah, you might be deferring your tax payment until the next period, but they're going to get you eventually. So, as I said, I'll skip that slide. How are we going to value the things that we put on the books? Because they have to go according to accrual accounting on the books that we obtain them. GAAP is what they call a historical cost principled society. GAAP states that whatever you paid for something is what you value it at. Even if you get a deal and you get it way below market, you can't put it on the books at the market price, even though it might be what it's worth. You have to put it on at its historical cost. So if you have a way to measure what you actually paid for something at the time of acquisition, that's how much you value that asset on the books for when you put it on there. And the same thing for liabilities. If you bought something that's, on account from somebody else and you got a deal on it, you can't put it on the books for you shouldn't put on the books for what it would cost you to go to somebody else. You put it on the books for historically what you are actually getting billed for by this customer that gave you a deal. So historical cost is the way to go, and when in doubt, you should always rely upon the historical cost. But there are other things that will need to be measured. The current cost. Sometimes I've book kept for not-for-profits before people will donate stuff. Well, then you didn't pay anything. There is no historical cost. So what do you value a donated asset for? That's its current cost. What you would theoretically have had to pay for that asset if it wasn't donated to you. So if you bought the asset for use and then it goes on its historical cost. But if someone donates it and you don't have a cost to put on, but you got to put the asset in the books because it's something that you have, then you go down the chain and you rely upon its current cost. And there's more. There's other situations where you're going to have to go look at the current market value of something. You're going to have to look at the net realizable value of something. You're going to value something at the present value of the future cash flows that you expect to bring in by use of that asset. These are all very specific situations, and we'll get into them as the semester goes on, piece by piece, when you have to value at NRV, if they call it net realizable value, when you have to value at the lower of cost or market. But when in doubt, if you know the historical cost is what you should value all things that get put on your books at. And lastly, the assumptions that we're going to have when we financial report. First is the going concern concept. The people that are using our information are going to assume that we are a company that is in operations and expects to be in operations indefinitely. If you know that you are in a bad way and you are going to have to liquidate the company, close up shop, declare bankruptcy, something along those lines, you are legally obligated to change your books around to accurately represent your position. Your assets, your receivables that you have up in there, you may not collect in that period of time. You can't have them up on there. Any expected, liabilities that you have, you're probably not going to have time to pay off. So if you know that there is a definitive end date to your company, you need to report that accurately instead of treating your company like a going concern. I'm not going to give you one of those situations going forward, but just know that when the end is nigh, if you will, you're no longer going to abide by GAAP policy because you are no longer a going concern and you're violating the going concern concept. The economic entity concept, you need to report the entirety of your business, though you may separate it out into different subdivisions, etc. But what you definitely can't do is report anything personal on your books. If you are accounting for a small business and your customer went through and bought a fishing boat, even though that person is a general contractor and they're trying to declare that as a business asset to write it off on their taxes, yeah, that's not going to fly. That's in violation of the economic entity concept. So, for an accurate position, make sure that any asset you're putting on the books is a business use asset and will help the business be profitable in the future. The monetary unit assumption. In today's global marketplace, even the smallest of businesses can sell on, Etsy, whatever, it's plausible that you're going to make sales in all sorts of different currencies. Well, you can't have a mix match of the two of them. So whatever the adapted accepted currency is for your area, in the case of here it's going to be the US dollar, means that all of your numbers have to be reported in that denomination in US dollars. If you have a receivable that's in Mexican pesos, well, before you report it and put it on your books, you need to convert that into what those Mexican pesos are going to be worth in terms of US dollars. So the monetary unit assumption always assumes that all of your transactions are in the same currency, even though they might not be. And lastly, the periodicity assumption. Information is much more useful if it's separated into artificial time periods. We talked a little bit ago about the period of time concepts that you have to report. How much income did you make during the period? For a user of your information, knowing the amount of profit that you made last year is much more useful than knowing the amount of profit that you made over the last 50 years. So you need to separate in your events, your books into artificial periods, could be a quarter or a year is the two most common, and it lets users of your information see the trend. How much income have you reported every quarter for the last 3 years? It'll let you know if your company's getting more profitable or less profitable. What were your total outstanding liabilities at the end of every quarter for the last 3 years? It'll let you know how your company is managing their debt. So you need to break your books into a consistent time period for how you're going to account. So you can't record revenues as though they would be the last year, but then break expenses into a month. Everything has to be the same. This is an accurate portrayal of our entire financial position for the last year.